Thank you, Mathieu.
So before we really dive into the outlook, though, I think that we should start by, understanding how we got here, and more specifically, like, why did equities fare so well last year? I mean, after all, it's something that caught, I think, the investment community by surprise. I think if you rewind 12 months, a recession or a hardish landing was the mainstream view. So how do you explain, what do you think is behind the strong performance that we saw last year?
Yeah, so I think that's a great place to start, sort of having an understanding of what was the impact of various macro dynamics in driving both stocks and bonds last year, because I think it sets the stage well for thinking about the upcoming cycle, right? When it comes to equity performance in particular, and I would say the equity performance in developed markets, there were probably two main factors at play. One that was more concentrated in the US was this growing interest in artificial intelligence, which obviously boosted equity returns for technology companies. So that was something that was more sector specific, if you will. But from a macro standpoint, arguably the most important factor, and something that hopefully you can see on the chart in front of you here, was the fact that growth in developed markets, certainly in the US, but also in other major developed economies, came in well above expectations. As you're correctly pointing out, at the start of 2023, the expectation generally was that developed markets were going to enter a recessionary period as demand was going to be affected by contractionary monetary policy. From our research, what we find is that rate hikes were in fact a significant drag on equity returns. So what this chart here shows you is the contribution of various sources of growth, or various macro drivers, in fact, to realized returns on the MSCI World or developed market stocks over the course of the year. So we saw a 21% increase adjusted for inflation in stocks, which was obviously very strong. And if we isolate the causal impact of rising policy rates and expectations of contractionary monetary policy, that actually exerted a fairly sizable drag. That would be the red bar that you see there. But that was more than offset by a variety of factors. Sentiment was at play. Part of that was AI. But on top of that, what we saw were essentially positive growth surprises, which by themselves allowed equities to rise, almost fully offsetting the drag from policy. But in addition to that, you had these second round effects at play. For example, the fact that growth came in stronger than expected fueled risk appetite, which allowed the dollar to weaken against most major currencies in the world. And we also had a favorable support from that. And similarly, because growth was strong, default and liquidity risk diminished, and so financial conditions were very favorable, which again boosted equities. That's in terms of sort of the equity performance. In terms of bonds, the issue, and particularly high quality debt, so sovereign debt, we essentially did not have these offsetting factors at play, right? At the start of the year, markets were expecting most major central banks to start pivoting as growth stalled. So what this shows you is basically our forecast for the Fed funds rate in December of last year. The work we do, for those of you that are clients and know our work, is probabilistic in nature, and so we typically try and assess not just the central scenario that would be the baseline in red, but the full range of outcomes. And then the dotted black line that you see there is basically what the market expectation looked like 1 year ago. And so essentially the market expected rates to peak at around 5%. We expected the same, but notice that the difference was that the pivot, or the market anticipated a much faster pivot, where the Fed and other major central banks became increasingly hawkish, right? And so these interest rate surprises, what they did was push up long-term interest rates. So they increased expectations around short-term interest rates as central banks became increasingly hawkish, which by raising yields drove down bond returns. And so that's why we ended up in a situation where equities did really well, but the bond prices didn't really recover after collapsing in 2022.
So Joaquin, speaking of the Fed and monetary policy, you mentioned that it was a big drag on equity returns and bonds as well. But since November, bond markets have really been pricing in more and more rate cuts. There's increasing expectations of a pivot on behalf of most central banks. And I think actually expectations are for 125 or 150 basis points of easing by the end of the year, actually. So do you think that markets are a little bit overly optimistic about this, or do you think that central banks could actually become a tailwind to returns this year?
Yeah, again, another great point. We've seen a significant shift in expectations, as you correctly point out, in the last 3 months. I essentially argue that both the bond and the equity market are essentially priced to perfection at this point, where they're expecting basically a 1995 type of soft landing, where growth only moderates, inflationary pressures revert back to target, and at that point, this allows the Fed to provide some degree of policy support without it actually being triggered by a downturn. And really what's been driving returns very recently in the last month and a half, I would say, the trigger was basically a shift in Fed signaling, where sort of before the December FOMC meeting, I would argue, and especially at the start of the fall, markets were embracing this sort of higher for longer narrative, which was partly behind the fact that yields were really strong, but that really changed in mid-December. So what you see here, I think, illustrates this point well. This is a breakdown of the evolution of the 10-year Treasury yield by source of return, right? Or by source of change, right? So you can observe changes or changes in the 10-year yield can stem from shifts in expectations around Fed policy. Expectations around growth and inflation can also affect movements in yields. And then you also have risk premia that could affect the price of Treasury bonds in the secondary markets. For example, if people have debt sustainability fears, for instance. And what you see is that following the FOMC meeting in December, you had this very aggressive drop in expectations around Fed policy. You're correct in pointing out that, in October or November, the market was expecting the Fed to cut rates maybe twice by the end of December 2024. We're now at a point where they're pricing in 5 cuts already. And so what we've seen is that a lot of that upside has already become realized, right? And so the question in that respect is whether central banks will in fact pivot as much as markets are already expecting, or if you're going to get less policy support or maybe a delayed pivot, right? And in thinking about that question, I think there are 2 key things that we need to think about, right? In most cases, I'd say in the case of most G10 central banks, policymakers have basically abandoned forward guidance towards a more data reactive approach. And what that essentially means is that movements in policy rates, so the speed and the magnitude at which they cut rates, will depend on underlying macroeconomic dynamics. So basically, whether it will remain in sort of a Goldilocks type interlude and shift towards stagnation, towards a recession, whether we'll get a soft landing, and so on. And then, so obviously macro dynamics matter a lot at this point. The other thing that matters quite a bit, and this has to do more with central bank decision making, is what economists often refer to as the policy space, which is basically the room that they have to cut rates before policy becomes expansionary, right? So this is illustrated in the case of the Fed in the chart that I'm sharing with you here on the screen. This shows a comparison between the Fed funds rate adjusted by consumer inflation expectations, that's in gray, dating all the way back to the pre-Volcker era in the mid-70s. And then in red, we have an estimate of what's called a neutral rate of interest or natural rate of interest, which is basically the real interest rate that is consistent with full employment. So at any point in time in which the gray line exceeds the red line, then policymakers are hawkish or there's contractionary policy, and vice versa when we have, much like we did in 2020 and 2021, a very negative real interest rate gap, then that basically highlights the policy is highly expansionary. Right now, for the US, and we find the same thing for, say, the Bank of Canada and the Bank of England, among major central banks, the magnitude of policy space is the highest we've had in at least 50 years, meaning that there's a roughly 300 to 350 basis point gap between actual interest rates and those interest rates that get you to full employment. So that means that if the Fed wanted to stimulate demand slightly, but remain in their own terms in restrictive territory, they could cut rates 6, 7, 8, 9 times and still have some degree of policy support, right? So that basically tells us that if they wanted to cut, they could cut aggressively without actually creating the same kind of stimulus that you would need in a deep recession, right? What will trigger this is basically the speed at which inflation moves back to target and growth stalls. I think that the main point in 2024 is there's obviously been a lot of focus on inflation in the last 2 years. Yes, there are near-term risks to inflation stemming from geopolitical risk and the disruption of supply chains and rising logistics costs, but core inflation, most leading indicators would point towards weaker wage growth and weaker service inflation, or inflation in sort of sticky segments of the economy. And this applies for most major developed markets and certainly for the US. And so what we think will happen is that there will be a gradual shift away from inflation as the key focus towards growth. And what we expect will happen will be, much like last year we had these positive growth surprises, we think that you're going to get these negative growth surprises in 2024. So this shows you our updated outlook for GDP growth in all developed markets. As I mentioned before, we have a probabilistic approach to forecasting both economic concepts and asset prices. And so we are more interested in tracking not just central scenarios, but the range of potential outcomes, right? And so what we find is that the most likely outcome is for growth to be of 0.5% in 2024, which is low. But what's most important, I think, is that there's only a 1 in 3 chance, or based on what we know today, we find only a 1 in 3 chance that growth will exceed the market consensus, meaning that there's basically a 3 in 4 chance of you getting of you getting negative growth surprises. And if you get these negative growth surprises, basically you're going to get a reversal in dynamics in equity markets, for instance, than what we had last year, right? So growth will no longer be a source of support. Perhaps financial conditions will tighten, and then we'll likely see a stronger dollar, and sentiment could potentially weaken, right? And so I think that's really important. When you map this into what it means for policy rates, in most major central banks, we're picking up a high probability of a pivot around late spring, so around the May meetings. There are differences by country, but in the case of the US, for instance, what we find is that a situation where unemployment rates continue to rise and inflation moves closer towards target would get you towards essentially 4 cuts, I think, is our baseline by year end, something like that.
So Joaquin, I have a little bit of a follow-up question on that actually. If you think that the rate cut expectations are a little bit premature or overdone, and these have been really one of the main driving factors behind what's driving long-term yields. And so if we're thinking about the investment implications of a weaker growth outlook and everything you went over, where do you see that the 10-year yield going from here, and what do you think that means for, let's say, the optimal stock bond mix in portfolios?
Yeah, so that's a great question. So in the last quarter, a lot of the movement that we saw in both stocks and bonds was a repricing of rate expectations, right? That drove up equity valuations, and it also lifted bond prices, right? So for instance, if you look at aggregate measures, so the Bank of America benchmark bond index for the US, it went up like 8% in the last 3 or 4 months, which is a lot, obviously, for bonds. Because now markets are already pricing a significant amount of rate cuts, it's less likely that you'll get these rate expectation surprises in the next quarter, right? And so what we find, especially if you also consider that we could get these near-term inflation surprises, is that the 10-year treasury, for instance, will probably fluctuate around 4% in the next quarter. So just to give you an idea, 4 months ago, we were picking up something like a 75% probability that the 10-year yield was going to weaken in the next 3 months, which obviously greatly improved expected gains on bonds and also improved the risk reward of equities, right? So we're not there, we're no longer there, right? And so basically what this means is that at least in the near term, so at least until central banks actually pivot, monetary policy becomes less of an important driver of the stock bond mix. And what really starts mattering is risk sentiment. This is a chart that we've shown a few times in our asset allocation reports. What this shows you is a comparison between the relative performance of high quality debt in developed markets, so sovereign bonds, against the MSCI World, that's in blue. And then in green, what you see is a measure of global risk sentiment. This is Citi's long-term macro risk index. And what you see is that there's a very strong correlation between both, right? So when the green line is low, that basically suggests that we're in risk on mode, right? That there's risk appetite in the marketplace. And in that kind of environment, riskier assets like equities are certainly much more attractive than bonds, especially if bonds have already lost, near-term upside because the market is already pricing in rate cuts, right? And so when you map that into sort of our asset allocation framework, what we find is that tactically we are now overweight riskier assets. This is a chart that comes from our global asset allocation report. We update it every month. What we basically do is we run our probability forecast models for major asset classes jointly, and then we run an optimization algorithm to determine, okay, what would, given underlying macro risks and near-term dynamics, how should you be positioning your portfolio to maximize upside risk and minimize downside risk, by which we typically mean, increasing your chances of making money with the highest expected gain and minimizing your chances of losing money with the lowest expected loss possible. We always set it against a benchmark. The benchmark we use is basically the average allocation of balanced mutual funds in the US. So for those funds, typically it's a 60-40 split. The vast majority of holdings are in developed market stocks, that's dark blue. There's a little bit of EM equities, and then there's also a significant chunk, about a little under 40%, held in developed market bonds, primarily US Treasuries, but there's also some offshore as well there. If you compare that to our own modeling framework, we typically actually run two separate versions. We have clients that have limitations on how much they can alter their portfolios, right, from one month to the other. And so we run constrained versions. That suggests a mild overweight over on equities over bonds. If you run the unconstrained version, the equity weighting rises to about 70% over the next 3 months, right? But and what I think is most interesting though is if you focus on sort of the longer term horizon, right? What we call our strategic asset allocation framework. Obviously, we have a lot of clients like large banks and mutual funds, for instance, that don't have the ability to rotate significantly in the near term. And so they're typically more interested in performance over the economic cycle. And notice that there's, between the third and the fourth bar, for instance, there's a very significant difference, right? Where the equity weighting over a 6 to 12 month holding period is so much lower than it is tactically. And what that is picking up is two things. One is, like I was mentioning before, the possibility of you seeing negative growth surprises, right? And so because that's very likely, that points not just to a direct drag on earnings, but also you could see a stronger dollar, you could see higher financial stress, and you could just see basically a shift in fund flows towards safer haven assets. And then in addition, when you look at bond yields, I was mentioning before that we think that the 10-year will remain in that 4% range in the next quarter or so. When you look at the 12-month outlook, that does change considerably. So this is our updated forecast for the 10-year Treasury yield forecast, but this is 12 months into the future. So again, there's a wide range of potential outcomes, but if you focus on the shaded areas, at the 12-month horizon, there we do pick up a fairly high, say a 2 in 3 chance that yields will fall below 4%, which is basically where they're trading at today. And you may wonder, like, why are you picking that up if the market is already pricing in rate cuts? Well, it's because you need to remember that the evolution of long-term yields does not just depend on central bank policy rate expectations, but also on growth and inflation. And so if growth were to weaken, what you typically get is safe haven demand, which just isn't present today, right? So basically a rotation in flows away from riskier assets and towards bonds, which tends to drive up their prices. So for those of you that are sort of really following fixed income, the technical term for that would be a compression in the term premium or the risk premium that people pay on to hold long-term debt until maturity. And so it's really that channel that starts dominating at that point. And that's why, if you're thinking about investment over the full cycle, there it's where we start suggesting, more conservative allocations, if that makes sense.
Thanks, Joaquin. And I mean, speaking of asset allocation, I have a question a little bit about sector rotation and specifically, big US tech firms, which are really, top of mind for everyone right now with a lot of these companies reporting earnings this week. And I mean, last year, a lot of the performance or the outperformance stemmed from all of these firms. And so what are your views on big tech? And do you think that these magnificent seven firms can continue to outperform?
Yeah, of course, this is another one of those hot topics, right? So we have what's going to happen to the Fed, and then big tech is another big one. We have them reporting earnings this week. If you just look at 2023 performance, the difference between mega cap technology stocks and the rest of the market is astounding. There's about a 60% point gap in performance between both. But I would argue that in order to understand what's going on with big tech, you want to take a step back and think not just about what's happened in the last year. Part of it is like a favorable base effect with a really bad 2022, but really take a longer term view and think about what happened in the last 3 years, right, or since the start of the pandemic. Really what happened was that a lot of liquidity flowed towards these big tech companies after the pandemic. Just to give you an important statistic, the market cap share of the S&P 5, or the 5 largest companies in the index, which are all technology companies today, historically fluctuates around 12 and 15%. As of the spring of 2020, so right after the pandemic, it jumped 10 points to 25, and it remains there. And a lot of the reason why that happened is actually because these big tech companies have much stronger earnings than the rest of the market. I'm not talking about earnings expectations, so what would happen in the future, kind of like what people were betting during the dot-com bubble. No, actual operating earnings. Real profit growth or real earnings growth for big tech companies, so Microsoft, Amazon, Apple, and so on, averaged about 11-12% adjusted for inflation in the 10 years before the pandemic, or 8 years before the pandemic. After the pandemic, it jumped threefold, right? So instead of it being 11, it was more than 30. And that provided a lot of boost to the market. In 2022, we didn't see support because you had a big drag from interest rates, but that support came back in 2023. So this is same thing. It's the drivers to composition for mega cap stocks. So it's the same thing as I showed you before through the MSCI World, but this is for big tech companies in the US. And what we're doing beyond what I showed you before, this is just for 2023, we actually took a stab to estimating how much of the movement is stemming from growth, how much of it is stemming from soft landing optimism, which would be very beneficial to cyclical stocks in general, and how much of it is stemming from AI. So in the last 3 years, a lot of the movement is earnings related, so in CAGR terms. But really in 2023, what we find is that interest in artificial intelligence, which we proxy by search intensity through Google Trends, accounted for about half of the gains. The other half, or a lot of the rest of the support, was basically soft landing optimism and expectations of even stronger earnings, which more than offset the drag from Fed policy, which certainly was present, right? So people look at sort of this wedge, for instance, between long-term yields and the NASDAQ, for instance, saying, the correlation or the causality between interest rates and tech growth, it didn't break, it's just that AI was present, right? That's what explains that gap between them. And so as long as interest in AI remains and soft landing optimism remains, we don't really see a reason as to why big tech would fare poorly. And so we're actually overweight, those sectors of the market that are heavy in big tech. So in IT and communication services, we are tactically overweight. By the way, we're releasing our equity sectors reports for January tomorrow, and so you'll be able to see that in that report. If we think about the cycle, sort of 12 months into the future, 6 to 12 months, the big worry I think that investors have beyond the economy slowing down, they are tech cyclicals after all, are valuations, right? If you look at just say the market cap share of IT over time, it's very high. It's not approaching .com levels, but it's very high. If you look at the, say, total returns against broad measures of spending overall, kind of like the blue line here for many tech, it also would suggest that it's really expensive. But I think if you go beyond these standard valuation metrics, you actually find that there are many tech segments or a lot of big tech is actually not that overvalued or not that expensive. And there's, I would argue, maybe two main reasons for that. The first one is that these sectors operate in segments of the economy that are much faster growing than GDP at large, specifically software. Software spending as a share of GDP has risen consistently over time. It's much faster growing than the economy, and it's also very stable against other sources of investment. And so that basically provides a lot of upside for sectors that rely on things like cloud computing, investment in software as a service, and so on. And then in addition to that, mega cap tech specifically happen to not just operate in markets that are fast growing, e-commerce is another one, but they also have these very large barriers to entry, right? And because they hold a lot of cash, they're able to be the first ones to invest in new technologies, disruptive technologies like AI, which further builds their barriers to entry, creates these network effects, and makes switching costs or makes switching towards other platforms costly. And so what that basically means is that not only are they operating in segments that are fast growing, but also because they have these barriers to entry, their markup is very strong, right? And so even if you imagine the demand growth starts slowing, they're able to preserve their markup much better than other parts of the equity market, including smaller tech companies. And so when you map that into our probability forecast models, what we find is it's unlikely that big tech will maintain the same differential in returns versus the rest of the market. That seems improbable. But the chances of outperformance remain strong, particularly against other cyclicals as the economy starts slowing. So we're actually overweight mega cap tech or mega cap growth, even over a 12-month holding period against other cyclical stocks. Yesterday, we published our US strategies for January that focused exclusively on big tech. So for those of you that are interested in this, I would strongly encourage you to reread this. We'll actually, I believe, be sending you a copy of the report again alongside with these slides later today.
So Joaquin, just speaking about big tech, there is this idea of US exceptionalism where, overweighing the US in global portfolios has essentially been a one-way bet over the past decade or so. But at the same time, I mean, if you look at standard valuation metrics, if you look at the forward PE ratios, for instance, the S&P does look relatively expensive, especially relative to a lot of offshore markets. And so do you think that 2024 could be a year where finally investors rotate internationally or no?
That's another question that we're asked very frequently. It's been more than 15 years almost of overweight and going long on the S&P has been essentially a one-way bet. It's true that the forward P on the S&P is about 20x against 10, 11, let's say, for a lot of offshore markets. And so, long term, you would expect that gap to narrow. I just don't think that 2024 is the year where that would happen for a couple of reasons. One is that we are expecting the dollar to strengthen as growth slows, and that that's a big driver behind relative performance between the US and offshore. The dollar, remember, has appreciated on a trend basis in the last decade, so part of that improvement stems from that. But then the other thing is sector composition, right? In the US, we have big tech, which, as I just mentioned, we still like. In a lot of the other offshore markets, the Eurozone in particular, these are essentially value cyclical regions. So what I mean by that is that they're super sensitive to the economic cycle. And so in a context in which negative growth surprises become likely, it's not, something that you necessarily want to start overweighing, at least for now, right? So for instance, this chart shows you a comparison between the DAX or the MSCI Germany. These are cyclical fluctuations in the MSCI Germany, that's in blue, so against their long-term trend, against production expectations by German manufacturers. So usually they move in sync. It makes sense because the DAX is very sort of tilted towards heavy industry. But right now, what we've seen is there's a big gap between both of these things, right? Where European stocks, and Germany is no exception to this, has really benefited from expectations of ECB rate cuts, imminent ECB rate cuts, I would argue, much like we've seen for the Fed in recent months. And the German economy continues to do really poorly, and expectations remain very weak. Historically, when similar gaps arise, German stocks contract about 10% on average in the next 12 months, right? So this kind of sort of analysis would suggest, maybe it's not the time to start overweighing offshore markets. That being said, I would argue that there are a few exceptions to this rule. The main one I would say is probably Japan. Japan is a market that did well last year, especially in local currency terms. We expect the relative performance of Japanese stocks to widen relative to other offshore markets even more so this year. This, for example, is the distribution for if you were to do like a relative value or spread trade between Japanese and euros and equities in the euro area. What this shows you is that the likelihood of you seeing excess returns or alpha on Japan is high. It's almost 70%, with also a fairly high probability of having double-digit gains. It's almost a 40% chance of this materializing. So the risk reward on Japan is a lot better. For Japan specifically, there are two things underlying this. One is that there's a lot more policy support, right? The BOJ remains ultra dovish. Secondly, we think that they'll gradually abandon yield curve control. The yen is trading considerably below fair value. As interest rate differentials between, say, the US and Japan and JGBs were to narrow, that should allow the yen to appreciate. The yen was actually a big drag on dollar-denominated investments on the Nikkei last year. So that dynamic, even if it partially reverses, would provide a lot of support. And so, when you read our global asset allocation reports, for instance, when you go into the country rotation section, you'll see, yes, we're underweight overall offshore markets, but there are, certain countries that do offer alpha opportunities, and Japan is certainly one good example of that.
So if I'm thinking a little bit beyond offshore stocks for a minute, I mean, they're not really the only asset class that have trailed the US in recent years. If you look at EM equities, they're also regular underperformers. I mean, I think they last outpaced the MSCI World in 2017. And I mean, last year there was this expectation that, EM stocks would be able to deliver alpha because of China's reopening, but obviously that didn't quite pan out, at least on aggregate. So what are your thoughts on EM positioning over the coming year?
Yeah, you bring up a really good point about China. EM did underperform the MSCI World last year, as it's done so consistently in the last 6 or 7 years, and even over a longer period, basically since the commodity super cycle of the early 2000s. After the 2011 or so, the dynamic really changed. But if you look at last year specifically, there's a lot of disparity in performance, right? The big reason why the aggregate MSCI Emerging Markets Index underperformed was because of China, which did really poorly because the economy failed to gather steam after zero COVID ended, right? So it remained, affected by things like a very weak property construction, for example. There's regulatory aspects or fears as well that affected Chinese technology stocks, for instance. But then there were other pockets of the market. Mexico did really well because of nearshoring. Taiwan and Korea, because of AI, also did really well. Brazil started picking up at the end of the year because cyclical conditions there were improving, and the ECB had done a really good job at bringing down inflation expectations. So there were some elements of the market that did well. Moving into 2024, this is certainly an asset class that we would we're looking in a lot of detail. We are overweight EMs actually today. One of the questions that we get is, why are you overweight EMs if you think that DM growth will surprise on the downside because they're high beta? And so what happens if you get a pullback in fund flows, which would typically weigh heavily on EMs? That's true. But actually, first of all, the drag of EMs against offshore markets in those episodes is not that pronounced. What this shows you, for example, is the cumulative performance of EM assets, stocks and bonds, against offshore stocks, that's in blue, in weeks around US recession. So let's imagine we were to get a recession around T0, then you see both EM equities and offshore stocks fall. Part of that has to do with the rotational liquidity back to the US. But first of all, they fall by similar amounts. But then what's really important is that they tend to recover a lot faster. And that's because as long as the slowdown is not stemming from factors that are EM specific, like say the Asian financial crisis in '97, there's nothing, there's no adverse long-term growth effects that would impact EM stocks, and so they tend to recover faster. In most emerging markets, I would say that macro fundamentals, or there's more limited macro balances than there have been in the past. So things like reserve ratios or current and accounts and primary fiscal deficits and so on, those are fairly limited, and so that reduces the risk of a lengthy pullback. And so the fact that they will likely recover faster gives us more confidence on betting 12 months or 24 months into the future in EMs. And then the other aspect is China. EM equities, even if credit conditions or policies worked by Beijing has disappointed, valuations for EMs are still way too low relative to the degree of policy supports provided by China and other major emerging economies. So, for instance, what this chart shows you is the evolution of EM stocks overall in gray against a 6-month prior change in the total social financing in China. And they typically move together. Around periods of downturns, you see credit impulse really picking up. Yes, it didn't really rise nowhere near as much as it did in 2009, 2010, but there's this big gap that remains, and kind of, if you were to do a similar exercise than what I mentioned for Germany, but on EMs, it tells you, anytime you've had this kind of gap arise, betting big on EM has really paid out, say 12 or 24 months into the future.
Right, so thanks, Joaquin. I actually have another question, and this one is a bit related to the EM views, and more specifically to commodities, and if they can serve as a good macro hedge in the current environment. So one of the things that our clients have been asking us a lot recently is essentially if there are certain opportunities in terms of the risk-reward profile, if that varies a lot across major commodity markets.
Yeah, so of course this ties into the EM view. I think maybe one thing that's important here to distinguish is that while EM assets and the commodity cycle are strongly correlated, it's not the only driver of growth. So even if we were to expect commodity prices not really rallying that much more, because valuations are low, because there's policy space in EMs and so on, because you're going to get policy support, that's enough to give you an overweight on EMs. And I say this because we're actually neutral on particularly energy commodities in the next 6 months or so. This shows you our latest forecast for Brent, and then it compares it against the futures curve for Brent. Again, this is maybe it's a couple of days old, but we've seen a similar dynamic occur in the last 3 months at least, right? So basically, what you find is that we find that the market is correctly pricing future oil market dynamics in the within the next six months or so, let's say, and then this gap starts appearing where there's excessive pessimism on commodities going into 2025, 2026, relative to what we expect will end up happening. And so when mapped into commodity positions specifically, what this basically would suggest is, let's say you're playing options, you stay clear and you remain neutral on commodities in the near term, and then you start going long through, say, call options on long-dated futures. And the reason why you're getting this kind of dynamic where you see this gap emerge, by the way, we see the exact same thing on copper, is because the market is underestimating the probability of there being persistent deficits or shortages on the supply side. In the case of oil, for instance, we have OPEC cuts, but we also, yes, we've seen oil production in the US rise a lot. That's because of productivity gains in oil rigs, but there's no real capex by oil majors as they continue to focus on cash flow. That eventually we find will restrict supply growth and will eventually result in a tight market. When you think about industrial metals, you have a very similar thing in copper, for instance. There's very limited mining investment right now. And then on top of that, what you have is sort of this green energy transition thing where you're going to require more industrial metals to meet demand. Even if China were to decelerate, as long as the energy transition continues, that's going to support demand for base metals, and that would again create a deficit. And so while we're neutral on commodities, I think in the near term, and in terms of it being an accurate hedge for inflation, well, probably less so as the economy stagnates. But long term, we do think there is a case for maybe calling it a structural bull market is a bit excessive, but persistent shortages arising that would result in fairly high commodity prices, even if China's economy were to slow down, which obviously was the key driver of performance in commodities in the early 2000s, right? So this would be much more supply side driven, if you will, moving forward.
All right, thanks a lot, Joaquin. And I think that really covers it in terms of, the themes that we wanted to cover. Now, before we move on to our Q&A, we wanted to leave our audience with, a little bit of food for thought. And so the next slide we have for you here is actually, the probabilities that our own models are assigning to the various scenarios, including the US scenarios that we actually told you about earlier today. That's what you see on the left. And we also have, a handful of global scenarios that we also polled clients about recently. And, looking at the poll results we got a few years ago, I think one of the most interesting results was, for instance, how few people believe in the Magnificent Seven outperformance versus our own models, which point to it being, a fairly likely outcome. What do you think about that, Joaquin?
Yeah, I think relative to the results that we've polled clients on, there are really probably two main things that stand out. I think the Magnificent Seven is probably the biggest factor. There's less than 10% of our clients have said that they expect the Mag 7 or big tech to continue performing in 2024. For the reasons that I mentioned before, we think the probability of that is a lot higher. Again, we really encourage you to read the piece we have on that earlier this week. The other big one is that we got a few weeks ago was on oil, where a lot of people expect oil to rise above $90 or rise and remain above $90 per barrel in 2024. As I mentioned, we are bullish on oil longer term, and so we certainly see oil exceeding $90 from a sort of fair value standpoint in 2025 or 2026. It's just that in the near term, the probability of that happening is quite a bit lower than what the poll results would seem to indicate. And again, the big reason for that is that if at some point, and especially if consumers start running out of excess savings, the impact of past rate hikes will start affecting gasoline demand and demand for distillates, and that limits the upside or the expected gain that you can get on oil in the near term. Now, could it hit 90 and not stick there? Absolutely, because of geopolitics right now. There's a lot of geopolitical instability and geopolitical risk, but it hitting 90 and remaining persistently about 90 is something that remains unlikely. And again, for those that are interested in our views on commodities, I'd encourage you to read our latest commodity outlook. We published that about 3 weeks ago, and next Thursday, so not tomorrow, but in a week from now, we'll be publishing our update for February, including a focus feature on crude.
Thanks, Joaquin. So just before we wrap up, we do have time for one question from the audience. And here's one that I think is really interesting, just to close out. So could you guide us through, any other calls or recommendations you have that you would categorize as being, high conviction plays that you could put on today?
Yeah, so of course, we just, went today through an overview of our general thinking around markets. There's a lot of specific or additional opportunities that we identify right now. One that really strikes me, which is sort of playing that sort of policy rate cycle, is our short-term interest rates in Europe. The market is much like the Fed, they're expecting basically imminent cuts by the ECB, basically because growth has really stalled in the euro area. And recently we put out a piece arguing why we find this to be very unlikely. There are a number of reasons for that. One is that we expect service inflation to remain fairly sticky. There's no real evidence that wage growth is really decelerating significantly in Europe. On top of that, you have the logistics aspect that is probably going to cause headline goods inflation to reaccelerate in the near term, which is going to push back these expectations. And then the job market in Europe remains strong. Like even if production is slowing down, unemployment rates remain low because of mobility gains in Southern Europe. And so all of that we think will push back the ECB's decision. And so the market is priced in something like 5 cuts by the end of the year. We find that 2 maybe is much more likely. And when you look at options markets, say on Euribor futures, for instance, they're even pricing in even a larger amount of cuts. And so shorting those futures is something that carries a very high probability of delivering alpha. And so I think a lot of the opportunities tactically will stem from the interest rate space as some of these rate cut expectations get repriced. And so that's really something that we're really focused on right now, specifically tactically when you're playing sort of these global macro trades.
Thanks a lot, Joaquin. And just looking at the time, I think that'll be it for our session today. So we'd like to really thank you all for tuning in today. And just as a reminder, we will be reaching out to you with a copy of the slides we showed today, as well as the results of the poll. So we'd like to wish you a great day, and we hope to see you at our next online briefing.